Joining me now is Keith Lerner, Chief Investment Officer at Truist. Keith, thanks so much for being here.
Hey, Caroline, great to be with you.
Keith, the stocks have shown remarkable resilience this year, despite plenty of reasons for investors to be cautious. What is the market getting right now?
Yeah, well, the first thing I would say is if you ask me the number one reason why this market's up this year, it's actually three reasons: profits, profits, profits. And I think, if we think about this bull market cycle, every bull market has a dominant theme. The bull market cycle this time is AI and tech. But, what's really amazing is as I look at the market today, I look at the S&P 500, we have forward earning estimates at fresh all-time highs. But we're also seeing fresh all-time highs in forward earning estimates for the mid caps and for small caps as well. So it's really I best described as an earnings boom right now, which I think the market is getting right.
For months, investors were worried that this market was too dependent on a handful of mega cap tech names. Do you think we're finally seeing proof that this bull market is broadening out in a healthy way?
Yeah, I'll give you an interesting stat based on that, that question that comes up. Right now, the Mag 7 is actually negative for the year, while the broader tech sector is up and the S&P is up, close to double digits. So I would say, based on that alone, we have seen some broadening beyond technology. And more recently, what we're seeing is a rotation well beyond tech. In fact, on a short-term basis, the equal weight S&P is now outperforming the S&P 500 over the last month or so. And during this bull market, we've seen about I would say about this is the fifth, what I would call rotation trade that we've seen. And history suggests that this likely has further to go, even though we still like the market cap S&P over time.
So if it's the fifth rotation of the bull market, do these kind of rotations extend bull markets, or is that a signal that we're getting late in the cycle?
No, I think it's a healthy sign. In some ways, we think about coming off the lows, and you think about the technology sector, which we still like. That is, AI and tech is the defining theme of this bull market. But off the lows in March, it rose about 47%. And when we look at this relative to the trend, it got way extended above the trend, and it outperformed any other sector by about 30 percentage points. So after the rubber band got very stretched, the question becomes, does money leave the market or does it go somewhere else? In this case, what we're seeing is that it's rotating to other areas. To me, that's a healthy sign of a bull market. I think ultimately money will come back to tech, but just like we had a consolidation after it got extended last year, I think it's due for a rest. And I think it's a good sign that money is going into some of these other areas that had lagged.
So talk to us about the next sources of leadership. If tech sort of takes a breather, where is the baton getting passed to?
Yeah, at least on a short-term basis, I think more broadly, I think, you've seen something like the equal weight S&P outperform. And by the way, we have looked at those four previous cycles. They tend to last about 3 months as far as the rotation cycles. So we're only about a month into this, so I think it likely has somewhat further to go. But then also the way we've really been playing it though is through small caps. In our annual theme, we talked about keeping a core in tech, which we still think is the right thing to do today. But because we suspected we were going to have some of these sharp rotations, and they're really hard to time, pairing that with small caps. And if you look at small caps right now, we're making absolute price highs. We're making fresh relative price highs. What's also important is it's not just sentiment. The earnings for small caps have actually been inflecting higher as well. And if you have a stronger economy, that all bodes well for continuation of that trade.
If we take a look at the sector breakdown for the S&P 500, though, so thinking a little bit bigger than mid caps and small caps, tech and energy, industrials still leading on a year-to-date basis, not necessarily the case this month. For energy, consumer discretionary, healthcare, financials at the bottom of the list there in terms of year-to-date performance. Where should investors be thinking about the next opportunities there? Do they keep investing in what's working, or is it time to shift into other areas?
So the way we're thinking about this now is, even though we think tech's due for a rest, we think money ultimately comes back, because when we historically have looked at bull market cycles, whether it's the 90s when tech was the leadership, or it was like the 2000s when we had industrials and emerging markets leadership, that leadership tends to persist towards the end, notwithstanding these kind of resting periods. So if tech's going to take one of those resting periods now, I think other areas that are likely to outperform near term are probably things like financials. We just upgraded financials about a week and a half ago. Industrials are acting better as well. So I think those are two areas that we think, at least on a shorter term basis, are likely to see some of those flows from tech.
What are you avoiding at this point?
At this point, we're still a little bit more cautious on some of the consumer plays, specifically consumer staples is something we downgraded more recently. If you have an economy that's still resilient, and then you still have this kind of two-speed economy, we're seeing for consumer staples earnings somewhat weak. We're seeing relative price trends somewhat weak as well. So, that's a key area that we're avoiding. And even though I say the economy is, somewhat strong, the broader consumer discretionary sector is much more mixed. So we're not seeing as many opportunities in those two sectors that are really, being hit by this two-speed economy that we all talk about often.
And thinking about if tech does take a breather, what does that mean for the S&P 500's performance from here? Because we know a handful of those names are responsible for a lot of its move. So is this an S&P 500? We know that the Russell's already outperforming the S&P 500, but overall, for those investors who are, maybe just exposed to the S&P 500, can they expect more gains from here, or could they expect consolidation?
Yeah, so I think I would probably answer that both. I think in the near term, more of a consolidation, maybe a little bit of a bumpier path near term, because as you mentioned, I just think, when you've had, such strong gains and such period of outperformance, it's normal to expect a bit of a consolidation. And historically, markets are typically two steps forward, one step back. With tech, you went three steps forward without any type of step back. So I think it would be, perfectly normal. And I would also say the earning trends for tech are still by far the strongest. But to your point, since it's so top heavy, even though you're seeing this underlying rotation, you're likely going to see some of those gains below the surface. And because tech is almost 40% of the S&P, and that's before we even take into account communication services, I think it's more likely of a churn somewhat, a resting period before it takes the baton back. But again, below the surface, people are picking individual stocks, doing sectors. I think there's still a lot of opportunity. And as you just mentioned, small caps are at fresh highs, and I think we'll be a beneficiary of some of that rotation as well.
So if an investor doesn't have exposure to small caps just yet, is it too late to get in, or is there still value there?
We still see value there. You have to, think about things in context and zoom out. Like your small caps, up until recently, the relative price of small caps was the lowest in about 20 years to large caps. So we just think there's more to go here. And I would also say it's also in some ways, even though small caps are thought about being economically sensitive, as investors look beyond big cap tech, what may be surprising for people is small cap tech is doing quite well. In fact, small cap tech is up almost 50% this year. So why is that? Well, I think as you have these trillion-dollar companies and money moves out and looks at the picks and shovels of this AI build, they're looking beyond this. So in some ways, small caps benefit from the economy improving, some more exposure to financials and industrials, but also it does have this kind of higher beta technology sector as part of the overall index.
Some investors might look at record highs and assume that stocks must be expensive. Are they? And I guess which areas of the market are expensive right now, and where is there still value?
Yeah, it's interesting when stocks make new highs, there's a lot of anxiety. And, I came into the business in the 90s, new highs was a good thing. And you went through a couple of crises as far as the tech bubble and the financial crisis, and people get nervous at new highs. When we test out, I guess to the first point, when we test out new highs and you look at a year later, returns are around the average, so not better or worse. So I often say like new highs are a feature of a bull market, not a bug. To your point on the valuation side, we are rich relative to history on different indexes, especially the large cap index. But I would also say, like, it's hard to really compare today's market versus the market from 30 years ago, because 1990 the S&P 500 tech sector was only about 5%. I mentioned earlier it's almost 40%. Those companies tend to have higher valuations, just in general, higher profit margins. And then when you move away from the tech sector and you look at small caps and mid caps, they're around the average valuation for the last 20 years. And then maybe the last point on this year, as we look at the S&P as a whole, the entire gain this year has been all earnings. The valuation has actually compressed this year. So that tells you how strong earnings are. And then to your question around what's expensive, what's not, listen, tech's around the 25 multiple. It's come in from 32. I can't call that cheap, but I don't think it's overly egregious either, given the earnings momentum. And as we look through most of the sectors, most of them actually look pretty reasonable. I don't really see much in our work that suggests things are well overheated as I look at the 11 sectors for the S&P, because a lot of these sectors, whether it's healthcare, whether it's financials, they have lagged somewhat. Maybe industrials you could argue is somewhat more expensive, but that's also because they're being looked at more as an AI play relative to history.
But thinking about what's actually cheap right now, you mentioned small caps. Are there any areas
Yeah.
that you're flagging as on sale?
Yeah, I would say on the margin, I would go back to financials being relatively cheap, and if the economy continues to chug along, which is our base case, they should be able to do well. Healthcare, we're more neutral. It's a cheap sector. We look at something that's cheap and that has earnings momentum. So that combination is somewhat lacking at this point, but that is a cheap sector. And with energy, we're giving that a little bit more of a leash. Energy was the hot sector early this year. Obviously, it's come down a lot as we've moved. Oil prices have come down from about $100 down to the mid 70s. But now, on a short-term basis, it's relatively oversold, and the valuations have come in quite a bit. So we think, again, we're going to give it some more room here. That's one of the cheapest sectors in the market that we see today.
It sounds to me like you're pretty bullish, even though you might be expecting some consolidation in the nearer term. What's the one risk investors are underpricing today, though?
Yeah, and I would phrase it like when I think about the overall market, our mantra for the last few years is this bull market deserves the benefit of the doubt. As a portfolio manager and as a strategist, I'm always worried about the downside. Where can things be wrong? And I would say, I mean, one thing that we're watching closely right here is the 10-year Treasury yield. It's hovering around 450. If we start to see that move up in a meaningful way, I think that would be a risk for the overall market. And then obviously we have a new Fed chair with a different point of view about how to move forward. I think that's going to provide some more volatility. And we're also in a midterm election year. And I will just say, even though we're positive, we do think it will be bumpier. Historically, we tend to have about 3 pullbacks a year of at least 5%. We've had one pullback. So I would just, I'd probably say be somewhat balanced in that stay with the primary trend, likely to see some bumps, whether it's interest rates, the midterm elections, or often it's something that we're not talking about today. I always talk about this carousel of concerns, like who had Iran on their bingo card as far as one of the main risks for the markets this year. So I think we have to be prepared for that. But what we're focused on is really going back to the basics is profits, profits, profits. And that's what we're going to be following to make sure those earnings continue to move up. If we start to see that change at all, our tune will also change. But so far, so good.
Okay, all right. I think it's a good time to transition to our rapid fire game of this or that. Quick questions, quick answers. Are you ready, Keith?
Ready to go.
Valuations today, expensive or fair?
Fair.
S&P 500 by year end, higher or lower from here?
Higher, and that's supported by when we've seen a lot of the momentum we've seen off the lows recently. Even if you have some give back, ultimately that should be a positive for year end.
How much higher?
A long time ago, I did away with trying to do price targets, but I would just say, going back to the studies that we did after we had these strong gains, they suggest 5 to 10% upside just based on a historical basis is potential.
So 5 to 10% more.
Correct, from where we are today. Just the basic
Okay.
studies that we did after having these kind of momentum thrust that we've seen since the March lows.
Okay, summer setup, pause or push to new highs?
I think we're more likely to have more of a summer pause, more of a refresh before making new highs towards the end of the year.
Bull market, early, middle, or late innings?
I would say it's more, maybe sixth to seventh innings is our thinking. Coming into the year, we called it the seventh inning stretch, but we still think this bull market has some time left. Last thing I'll just say quickly is the first part of the bull market tends to be the strongest, and the last part of the bull market tends to be the second strongest. So keep that in mind.
Market leadership, tech or broadening?
Near term broadening, money eventually I think rotates back to tech, but I think that's a later in the year story.
Biggest beneficiary of that broadening?
I'll go back to the theme we've talked about today is small caps.
Small caps or financials from here?
Ooh, that's a tough one because for small caps to work, you need financials to a certain extent. But I would still stick with small caps. I think it's more leverage to the overall economy.
More upside, energy or industrials?
Ooh, that's a tough one. One's a mean reversion play, which is energy, and one's a more momentum play, industrials. Um, I'll go with energy as far as more upside potential, given how oversold it is.
Better beaten down sector, healthcare or consumer discretionary?
I'd go with healthcare, even though we call it Charlie Brown, that it tends every time you think it's starting to get going, it drops the ball. But I'll go with healthcare.
Consumer discretionary or consumer staples?
Uh, I would go. We're underweight both sectors, so that's a tough one for me. Can I do a push on that one?
So neither.
Either. Yeah, I'm not. We're not bullish on either sector right now.
AI trade, healthy leadership or too much concentration?
I think healthy leadership. I think some people, something that viewers should keep in mind. There was a study done by Arizona State that showed about 2% of stocks account for almost all the outperformance of stocks over time. So I think it's basically just a reflection of the AI innovation bull market that we're in.
Biggest second half risk?
I think it's rates is probably the biggest risk. I think the midterms as well, and I think oil looks pretty contained, but that's something to keep an eye on as well.
Rate hikes this year, yes or no?
No, we're still in the
Rate,
camp that the Fed's going to stay pat.
okay, so no rate cuts either. Market sentiment today, complacent or appropriately optimistic?
On a short-term basis, slightly complacent, not at an extreme, but the put-to-call ratios are at a extreme, meaning there's been a lot of buying and not a lot of protection, so slightly complacent.
Record highs, reason to be cautious or reason to stay invested?
Reasons to stay invested, that's what the work suggests. Again, a feature of a bull market, not a bug. As long as it's backed by fundamentals, which this one is in our view.
One word to describe how you're feeling about the market for the rest of 2026.
One word? Oh, I was going to say give the bull market the benefit of the doubt. I don't know if I have one word, but uptrend.
Keith Lerner, Chief Investment Officer at Truist, thank you so much.
Thank you.
If you enjoyed this Street Talk, check out our full interview with Mark Gibbons. He has an 8,200 price target for the S&P 500 and explains how to position for the next leg higher.